When it comes to REITs, they are a total return investment. You get both a solid dividend yield as well as solid capital appreciation based on the underlying real estate they own. If you combine all of the commercial real estate into one bucket, it is actually the third largest investment class in the US, trailing bonds and equities. Commercial real estate makes up 16% of the investment market. There are roughly 535,000 properties that are owned by REITs in the US, with 150 million Americans having some sort of REIT investment, whether that's through a fund or investing directly in the REIT. Investing in REITs is a great way to diversify your portfolio and gain real estate exposure. More importantly, though, it creates millionaires. Andrew Carnegie once said that 90% of millionaires became so through owning real estate. And in today's video, we are going to take a look at two real estate investment trusts that have bright futures and will pay some solid dividends for investors that are willing to be patient. So if you're ready to look at two REITs, then do me a huge favor. Smash that like button down below, subscribe to the channel, and let's get started. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. If you have watched any of my videos in the past, well then you know my admiration for dividend stocks, whether it's a REIT stock or not. One way to find high-yield dividend stocks is by using the Moomoo app, in which you can access a high list of high-yield stocks by going to the market section, and then at the top you can click US. Scroll down to the featured list section, which you can click on and see a high dividend list of stocks ready for you to browse through. Once you're here, you can select on the stock that you may be interested in and dive deeper into company details and, of course, dividend details to help you make more informed investing decisions. If you have never checked out Moomoo before, now is a great time to join because you'll get up to 16 free stocks upon depositing, including one full share of either Tesla or Expedia. Moomoo is great for investors of all levels, from beginners to even expert traders, offering exceptional customer service to go along with it. Thank you to Moomoo for sponsoring today's video, so make sure you click on that link down below so you can receive up to 16 free stocks. And now back to our discussion revolving REITs, two REITs that we have not discussed on this channel before. So both of these REITs are healthcare REITs. They're actually both competitors, so it's not really about owning both of these REITs, it's more about owning one or the other. It has been known for a while now that the population in the US has been aging at an extremely fast pace. In addition, people are living longer, but also dealing with more chronic illnesses. In the year 2020, the number of people 65 and over, the ages of 65 and over, was roughly 57 million. By the year 2040, that number is expected to be 81 million, nearly a 25 million increase over that time. REITs in the senior housing space have really been planning for this demand for quite some time now. It is evidenced by the supply glut we have seen over the past few years. However, as supply continued to increase and then we got hit with a global pandemic, this did not bode well for senior housing REITs. But now with the pandemic behind us and new supply coming to a halt and seeing an explosion in demand, this bodes very well for senior housing REITs. And those two REITs that we're going to talk about today are Welltower, stock ticker WELL, and Ventas, stock ticker VTR, which are two giants within the senior housing space. We're going to look at both of these REITs side by side as we walk through each of them, their portfolios, their valuations, their dividends, as well as their 2023 guidance. So let's begin with Welltower. Again, stock ticker WELL. Looking here, you can see that Welltower has a market cap of $41 billion, making them actually the largest in this space. Over the past 12 months, the stock is roughly even, but year to date, they're actually up 24%. So a pretty solid year so far for shares of Welltower. Now let's take a look at Ventas, which has a market cap of $20 billion, making them half the size of Welltower. Over the past 12 months, the stock is down 6%, and year to date, it is up 8%. So that gives us a quick snapshot on how the stocks have been doing, as well as the company's market cap. But now let's take a closer look at the business, and in particular, each of their portfolios, beginning with Welltower. Welltower has a total of roughly 2,000 properties, with the majority of those properties being either senior housing operating or senior housing triple net, which again, for those of you unfamiliar with REITs, the term triple net means Welltower owns the building but leases it out to third-party tenants, and those tenants pay not only rent, but they also cover typical landlord costs like property tax, insurance, as well as maintenance. In the second section down below, you can see the senior housing operating properties saw NOI jump 23.4% year over year in the latest quarter, which attributed to the same store NOI portfolio growth the company saw of 11%. These, again, are same store figures, meaning the properties have been in place for at least 12 months in order to be calculated here, which gives us more of an apples to apples comparison. Occupancy for the portfolio was in the mid 80% range. One reason that I like both Welltower and Ventus is because they deal more with the private pay patient, meaning that those patients are using their own insurance, not relying on Medicaid or Medicare, which is more government regulated. Now let's take a closer look at Ventus and their portfolio. Here you can see Ventus has over 1,200 properties led by senior housing, which with the triple net lease properties as well, that sector makes up over 50% of the portfolio. But Ventus also has exposure to medical office buildings as well, which has been seeing more favorable growth in recent quarters. In Q1, Ventus reported same-store NOI growth of 8.1%, which saw senior housing NOI surge to 17.4% growth year over year. Occupancy has also been trending higher now into the low 80% range. In the company's latest quarterly earnings call, CEO Deborah Cafaro alluded to these strong results that they're seeing, which is not only leading to higher occupancy, but higher NOI, and with that has also brought along higher operating costs. Management believes the company is not too far away from reaching their pre-pandemic levels in terms of occupancy and margins, just based solely on the demand they're seeing. All positive things for the business moving forward. Now, before I move on to valuation, let's quickly touch on the dividend and the history of the dividend for both Welltower and Ventus. Given the negative impact that the global pandemic had on the senior housing sector, both Welltower and Ventus were forced to slash their dividends, a dividend that has not moved since they did that back in summer of 2020. Ventus currently pays an annual dividend of $1.80, which equates to a dividend yield of 3.6%. Again, this same annual dividend has been paid since mid-2020. Welltower, like Ventus, has also not increased their dividend since slashing it in 2020, and they currently pay an annual dividend of $2.44 per share, which equates to a dividend yield of nearly 3%. So a bit of a lower dividend yield for Welltower when compared to Ventus. Now let's take a look at guidance and what management expects for the full year in 2023. When it comes to Welltower, management increased their 2023 guidance after a solid Q1 and now expects 2023 FFO to come in between $3.43 per share and $3.56 per share. The middle point of the guidance is in line with where analysts expect Welltower to end the year at $3.52 per share. This equates to an FFO multiple of 23.5 times, which is above the company's 10-year average of 17.3 times. But a lot of that is skewed due to the single-digit multiple the stock traded at for years in 2020 as well as 2022. On average, Welltower has traded a lot closer to 19 to 20 times. The stock has had a great run already in 2023 after a dismal 2020 and 2022, but still trades below its pre-pandemic lows. As occupancy and NOI continue to climb, Welltower is less about a 2023 story and more about the long-term upside the REIT offers. When you look out over the next few years, you can see the growth analysts are expecting as well. 12% FFO growth in each of the next 2 years. Now let's take a look at Ventus, which I believe trades at a more intriguing valuation. Management is looking for FFO between $2.97 per share and $3.11 per share. Looking at this fast graphs chart, analysts are looking for 2023 FFO of $3 even. As such, VTR shares trade at a 2023 FFO multiple of 16.4 times, which is much cheaper than that of Welltower. Again, Welltower is double the size in terms of market cap. Over the past 10 years, which includes those very low days in 2020 and 2022, which dragged down the multiple, the average FFO multiple is 14.7 times. Looking at the 5 years leading up to the pandemic, the FFO multiple was closer to 16 times. Again, investing in either of these REITs is not about today's valuation, but the long-term upside, and analysts are looking for nearly double-digit percentage upside each of the next 2 years for Ventus. Both of these REITs have exceptional management teams that have really been able to weather the storm in what has been a difficult environment for senior housing. But now things are starting to turn for the positive for both of these REITs. We're starting to see supply, which was exploding for years, start to sit at a standstill, and we're really starting to see demand start moving in the right direction, which is a big positive for both of these REITs. In the comments section below, let me know which of these REITs would you rather own for your long-term portfolio. Again, both of these REITs isn't about the performance they're going to do this year. It's about the long-term performance and the upside that both of them offer for you. Thanks again for watching. I hope you enjoyed the video. And with that being said, if you haven't done so, smash that like button down below, and we'll see you in the next one. Take care.